delay. This hearing was called prior to the recent announcement by the Secretary of the Treasury and the President about a restructuring, but it does seem to me that it is very relevant. It's become even more relevant due to that. Now, we did call the hearing specifically to talk about further legislation regarding our bill on subprime, and that is a complex and ongoing subject, and I will say that the Senate obviously is not going to act this year. We will have time to talk about further modifications that could be included in conference. It would be my intention to have this committee act on some of those before we did do anything, if we were to do anything. Our colleague from Delaware, Mr. Castle, had a very interesting bill that we thought about in conjunction with the subprime and didn't have enough time. And on the other hand, also many of us believe that we need to do a little bit more, maybe a moderate amount more in enforcement of the restrictions on inappropriate mortgages, and that's before us in general. There are the pattern and practice is one possible view, but we are open, I believe, many of us, certainly my two colleagues from North Carolina and many others, to improving this. I should also say that people have raised a question about some ambiguity in the language by which we seek to prevent people from being compensated for getting people into higher interest rate loans than they otherwise could have. And that was certainly our intention. People think there's some ambiguity. I always prefer redundancy to ambiguity. And in consultation with the gentleman from North Carolina, Mr. Miller, we've been working on it. If we get to that, we will have language that will make it very clear that there is no such possibility. I do then want to make 2 points today. One is a general point. And what's been striking about the subprime crisis is not simply the subprime crisis, but the extent to which it has spread to be the most significant financial problem in the world, it would seem, since the Asian financial crisis. And as I think about it, it does seem to me there is a problem intellectually and then ultimately politically that we in the executive branch, in the legislative branch, and in the private sector all working together have to solve, and that is we need to find a substitute. And it's a substitute for, and the bank regulators are here, and I've always been told by bankers the prime rule of banking was know your borrower. And what's happened is we have created through a whole group of new methods a situation in which you not only don't know your borrower, you have no idea who your borrowers were or are. That is the nexus between the borrower and the lender, I believe, turns out to have been a more important safeguard than we thought. And we have been trying very hard, the private sector has, and some of us in the regulatory field, have been trying to find a substitute for the borrower-lender relationship. And we have, it turns out, been less successful than we thought. That's what risk management it is. It's a substitute, it seems to me, for trying to know whether the person you lent the money to can pay you back. And what we need to do is to figure out, in not just the subprime, but in general, how we deal with that. And that will be a subject of further hearings. How do you keep the benefits of this increased liquidity and find some way to preserve, again, what had been the great safeguard of not lending money to people you didn't think could pay you back? When you don't have to worry about whether they pay you back, and when the people who now own the loans don't know who they borrowed, who in effect they lent it to, ultimately we have problems. With regard to the proposal that the administration has put forward, I welcome it. It is a recognition that the increase in the rates would cause serious problems, and that some public sector concern with that is appropriate, that the market can't be left entirely to its own, although there is no violation of anybody's legal rights. But I did tell Secretary Paulson in a conversation this morning, in fact, that we had, there are a couple of problems I have with it. First of all, I think it is a grave error to say, as I understand the proposal does, that there's a cutoff at a 660 FICO score. Apparently people have thought that a FICO score, a credit rating, was a good proxy for income. I don't think it is. And I think we would be making a great mistake, frankly, morally and also politically, if we tell two people who are otherwise similarly situated that the one who has been more careful about his or her credit is not going to get the benefit, and people who have been less careful will. That is, I think the 660 FICO score is a great mistake. I understand there's a need for some kind of screen, but all of us, I think, literally all of us, conservative, liberal, Democrat, Republican, etc., we've all been telling people, please, don't get into debt beyond what you can handle. Try and keep your credit score up. We've all been telling people to keep their credit scores up. To have a situation in which people who listened to us and got their credit scores up are now going to be worse off vis-a-vis other people who didn't keep their credit scores up is a great mistake. The other flaw, I think, from the standpoint of someone supportive of the general idea, and I welcome it and I appreciate the initiative and I appreciate what Chairwoman Bear and others have done to urge its adoption, is the failure to do anything about a prepayment penalty. It seems to me that if you delay this for 5 years, that's a good thing, because the hope is that during that period people can find some way to refinance and avoid the reset. But if they still face the prepayment penalty, as I understand it from Secretary Paulson, nothing in this proposal does anything about the prepay penalty except, in effect, to toll it, as lawyers would say, just to push it down the road. But not having the prepayment penalty addressed, I think, is a flaw. Finally, here's one where I do think there is a problem, but it is not the administration's fallback. And let me say here, I'm going to say this later, it is not comity. It goes against a lot of the norms. But I have to say that the increasing inability of the United States Senate to function is becoming a threat to governance. And that's not partisan. I know my Republican colleagues felt it when they were in the majority in the House and the Senate. We feel it today. Senate norms, beyond partisanship, have evolved to that point. And I say that because one of the things that we would hope you would do with the time that is being bought by the 5 years is to help people get alternative financing. That means, among other things, obviously not entirely, full use of the FHA for subprime borrowers and full use of Fannie Mae and Freddie Mac. This House has passed, with a good deal of bipartisan support, differences about some aspects, but good deal of bipartisan support on core principles for having the FHA and Fannie Mae and Freddie Mac more able to do this. They have been languishing in the Senate for a variety of reasons. And I hope that we will go forward with this. I believe it is a mistake to use that FICO score screen. I hope they will recognize that you need to do something about prepayment penalties. But I also hope that the Senate will act on the FHA and Fannie and Freddie, the GSE bill, so we can move forward. The last point is just a question, and my staff had raised it with me, and I forgot to ask it, and that is, does this allow for, or it does not allow for, because people can still do what they want in the private sector, but does it contemplate negative amortization? If it does, that would be another grave error. Putting off this reset and then having people get further into actual debt during that period would seem to be counterproductive, and we have not been able to determine whether that does or doesn't contemplate not doing negative amortization. The gentleman from Alabama is now recognized.